Welcome back, everybody. It's good to have you to another real estate market update for the Greater Milwaukee Area, this time July 2023. I hope you had a great summer so far. Maybe you did some traveling, had some much deserved time off, enjoyed some quality time with family. I just got back from a hiking trip in Norway, which was absolutely awesome. Highly recommend if you've been thinking about doing something like that. But I'm excited to be back here working with clients and also squeezing out some time for a quick market update for you guys. So what are we talking about today? We have seen the market change quite profoundly in the last few weeks. About third week of June, it started happening a little bit, and we've seen it for the last 3 weeks. The market is transitioning out of that crazy spring market, transitioning into a much more stable summer market. And what that means, we're going to talk about today. Also taking a look at some economics locally and nationally that might be impacting the housing market in the next months to come. And with that, let's get started with a quick look at the numbers from MLS. So straight out of MLS Data here. And I have here June 2023, always compared to last year in June. And then below I have the benchmark year, June 2015. That was the last time we had kind of a normal, neutral, balanced market in Milwaukee, just so you have some reference here. Inventory was down again in June, minus 8.2%. So that is a smaller number than we had in previous months. So we're still seeing a negative here on the inventory development compared to last year, but at least that negative is getting smaller. Of course, still a very large gap if you compare it to the 13,000 we had back in 2015. With that, sold units, of course, are down as well, minus 23.5%. So a very, very restricted market just because of inventory, not for a lack of buyer demand. We have tons and tons and tons of buyer demand, but inventory is just not there. So only 2,300 units sold in June, and that's substantially less than the 3,300, 3,500 we would expect in a normal year. With that, days on market, only 5 compared to the 50 days. So this is physically about as quickly as you can get a house on the market, get it under contract. So good listings will sell usually in the first 2 or 3 days, sometimes even in just 1 day. And with that, of course, prices continue to push up. $332,000 is the new median sold price in the Milwaukee area, quite a bit more than the $185,000 we have seen in 2015. Where this is taking us on price trends has been a big topic on this channel in the last few months. So you might want to go back and watch some of the videos, but we're also going to talk a little bit more later in this one. So I think we have seen the market peak in the third week of June. It was kind of interesting to see how the overall temperature in the market came down, velocity came down, the air got out of the market. And of course, then we had vacation season starting with 1st of July, and that has really ended the spring market officially. But with that, the market velocity and the market competitiveness have been reduced in July, but still don't expect this to be like easy because good listings are still selling with multiple offers. And the Milwaukee market, I think this is the most important thing, is returning to a more normal seasonal pattern. So we are seeing what we would expect for this time of the year, even though it is on a kind of new normal where everything is on an elevated higher level, higher velocity, higher prices, higher everything. But we're seeing everything stabilizing, and we're seeing that new normal really being established after the unicorn years that we have seen in 2021 and 2022, which was really absolutely crazy. It's good to see some stabilizing going on in the market. Let's take a look here on some economics. So here we have inflation that has been a huge topic in the media, but you don't hear much about it anymore. Why? Because inflation is coming down. This month, data came out with consumer price index at 3.1%. We were at 9% at the height of inflation. And so now we're nicely coming down. We are almost there where we used to be in the years leading up before COVID. So the Fed is obviously making some headway there, and they're not quite there where they want to be, but at least we're getting into the right direction. So what they're trying to do is create a soft landing for the economy without crashing the job market. And when you look on the latest data here, it looks like this might actually work out. So we have here 2 lines. The blue line is unemployment. So this is the lower of the 2 here. So we have about 6 million people that are currently looking for jobs. And we also have about 9.8, almost 10 million open jobs. So this is coming down a little bit, but not very fast. So at the moment, not a huge impact on the job market. So it seems like the job market might hold out stable. And of course, that is a major impact for the real estate market, because if people are losing their jobs, that impacts, buyer psychology. Everybody gets scared. Nobody wants to buy a house. On the other hand, if the job market is strong, people feel confident in their future income potential, then that has a positive impact on the real estate market. Quick mention here, unemployment rates, Wisconsin here, I'm very proud of our state, 2.5%. This is, it's awesome on one hand because national average, very low, 3.6 is low, 2.5 is crazy low because that is actually hurting businesses' abilities to grow as they're, expanding products and services. They can't find people to grow their businesses. So this is actually hurting. We need to do something about this. But on the other hand, it really speaks volumes about the strength of the economy that we have here in Wisconsin. What's going on with the funds rate? So earlier this week, the Fed announced another increase. You may recall that they have paused the month before, said we're going to watch how things are going, and then maybe adjust the funds rate up, hike the rates up 1 or 2 more times this year. This apparently was the first time they executed that, and we're now at 5.5. And you can see here on the big chart how quick and how decisive they actually went up with the rates. This is a lot faster than we've seen it in the past. And I have here the long-term history over the last 45 years or so. So you can see in comparison how aggressive they have been. But we're getting to the point where they have accomplished or start to accomplish their goal that the economy is cooling down. They're able to suck all that extra COVID money out of the markets, which is a healthy thing to do. We need to do that to curb inflation. We're not quite there. They want to get to 2%, but it looks like we're getting there, and we might see one more funding rate hike going up. So this is actually not impacting mortgage rates directly. I spoke about this earlier on this channel multiple times this year, so I don't want to repeat something that you already know. If not, go back and watch the earlier videos. But basically what the fund rate is impacting is credit card debt rates are going up, car loans, consumer loans, all that is going up. And of course, that is restricting people's budget and people's ability to spend money, save money for housing, spend money for a down payment, etc. So that has an impact on housing market, even though it does not directly drive mortgage rates. That's a separate mechanism. But that's also going somewhat in the same direction. So with that, the big question is what's going on with the housing market in general? Where's the sentiment? And I found a big study here that came earlier this summer from Freddie Mac. And what they found is that 18% of the people that they have surveyed across the US are likely to buy a home in the next 6 months. So they have the intention to do something in the relative near future. That is a strong number, but a lot of them are holding back because they're looking at the economy, they're looking at the rates. There's still a lot of uncertainty in there, and they're just waiting for some good news and then hop into it. At the same time, on the selling side, you can see we have here 16% of all the surveyed people that said they are likely to sell their house in the next 6 months. You can see just right here between the difference between of them two that the inventory problem is not getting easier because you have more people on the buying side than on the selling side. And also, not to forget, everybody who is selling is usually also buying because they need to live somewhere. What's going on with interest rates? So I'm talking about the new normal here. And when you look at this chart of interest rates over the last 9 months, you can see we are very consistent between 6 and 7% mortgage rates. And while the market was sticker shocked initially when we went from sub 3% into 6 and then later 7% range, that sticker shock is slowly subsiding. In historic dimensions, that is actually a very normal mortgage rate. So it's not crazy high. Crazy high was back in the 80s when we had 15, 16, 17, 18% mortgage rate. Some of the boomers have bought their first house with an 18% mortgage rate with negative amortization. So the amount of money they owed on the house increased every month instead of coming down. So from that perspective, it's actually not so bad. But from what we've been used to over the last 5 or 10 years, these are actually higher rates. But the market is getting used to it. The big question is, what can we expect for the near future? And we just got the latest data from the Mortgage Banker Association. They always publish an expectation for the next 12 months. And you can see that they're still holding firm on their expectation that rates are coming down. We should expect something below 6, so in the high 5s, maybe by the end of this year, maybe early next year. And psychologically, this is very important because we know this from surveys, I know this from talking with clients, is as soon as you start seeing a 5 in the mortgage rates, it feels a lot more palatable, both for first-time buyers as well as for somebody who's selling a home who's currently what we call rate locked because they have a 2.75 or 3% rate, and now they're looking at the prospect of a 6 or 7% mortgage rate. So it's a lot easier to jump from a 3% to a 5% than to a 7%. So this has a huge impact on the real estate market for reasons that we have plenty discussed on this channel earlier. This year, there is a relatively good chance, a relatively high likelihood, and the Mortgage Banker Association is holding firm on this in the latest forecast that we are going generally seeing rates come down over the next 12 months. Of course, the future hasn't happened yet. Nobody knows for sure, but it's an educated bet. Let's take a look, see what buyers are doing. Here I have a chart that I haven't shown you in a while. This is showing time data, so we're tracking very, very accurately how many showings are happening every month. This is Wisconsin data, and you have here the last 4 years. The orange one obviously is the current year. I'll walk you through this. So this has been our spring market. Then we had here 4th of July week, and this is where we are currently. So we are above currently the year 2022 and 2021. The light blue year that we have here is the year 2020, and that has been kind of an outlier because that was the first COVID year. Remember, here we had the lockdown, and then this was kind of a unnatural, pent-up demand, catch-up effect here. So if you negate this really exceptional year, then you can say that we have buyer demand actually in Wisconsin higher right now than we have seen it in the last 2 years. So that is remarkable, but also we are moving into the part of the year where buyer demand is traditionally a little bit more muted compared to the spring market. Don't misread me, still very competitive, still multiple offers and all that good jazz, over asking price. But compared to the craziness that we've seen in spring, it should get better. So this is what I call a buy box. There is a video that I will link here that I recorded last year, and I should probably do a refresher on that. It's really that fall is the best time. Late summer and fall is the best time to buy a house in Milwaukee. The prices are softening, and it really helps if you're on the buying side. On the selling side, you still have a fairly good market. It starts dropping off here really with Thanksgiving. So this is our buying box. This is a very attractive time of the year that we are entering. And if you want to know more about that and see the data, also how prices compare, spring prices versus fall prices, watch that video about how the seasonality is changing every year here in Wisconsin. Seasonality is also a big topic with inventory. Here I have national data, so the many curves that you see here are showing you the inventory that we see on the US national market. And in every single year, except of the first COVID year with the lockdown, the orange one here, we have seen inventory kind of following this curve. So we have a spring inventory maximum, then we're going off here into the summer market, fall market, and then drops off here right around Thanksgiving. So this year on a national level, we are right around here. So significantly lower inventory than what we would have expected. And so we do have a housing shortage. We need more houses. And that's also a topic that I have discussed here quite a bit. Quick refresher. So this chart shows you housing starts since the year 2000. And this is when we had the big crash in 2007, 2008. And housing starts really went down here very, very low and then slowly started climbing up. And now, last month, we have seen a sudden jump of 22% more housing starts, 1.6 million. So this is new construction. This is basically a vote of confidence from all the home builders across the US. And to give a little bit of a perspective what 1.6 million means, so long-term average is we need to build about 1.5 million houses in the US to keep up with the demand. So that's just a long-term average, what we normally need. In the years leading up to 2007, we have overbuilt. We built 1.7 million on average, and then especially the last few years, we were going crazy. There was no real demand for that from a demographic point of view. It was just really the banks pumping out these subprime mortgages and qualifying buyers who had really no business buying a house, and the builders were very happy to oblige and just pump out tons of houses. So we've overbuilt. We all know how that ended, and now we need to catch up because we have a chronic housing shortage, and you cannot fix a problem that has been built over 10-15 years. You cannot fix that quickly, but it's going in the right direction. 1.6 million is a good start, and that will go a long way. The only problem is, where are the housing starts happening? Those were national numbers, and if you look and break them down, most of them, over 900,000, were actually in the south. Second most is the west, and then the Midwest is coming in with 282,000. The problem is, in Milwaukee, we are not really doing that great. I just looked yesterday. In the entire Milwaukee metro area, we have only 224 houses, new construction, on the market currently. So that is not making a huge dent in a housing market. And the other problem is, they are priced a lot higher than most first-time home buyers can afford. New construction, if you're looking for a spec homes or something that's almost move-in ready, where you can get into it in the next 2 or 3 months, is going to be around 550 to 650 for the most part. And that is just oftentimes too high for first-time homebuyers. So that will not provide a meaningful relief to the housing shortage that we do have currently in Milwaukee. All right, speaking about Milwaukee, let's compare ourselves a little bit to the national average. So what I have here is a comparison of Milwaukee prices here in light blue compared to the national average. You can see that Milwaukee prices are quite a bit lower than the national average, even though we've been going up quite a bit this year. Milwaukee is, in my opinion, not a below average city. This is just the US average. So this is not, expensive high-flying markets like New York or San Francisco. This is just the US average, and we are still quite a bit below the US average. And we've become a very mobile society. People are moving around, people are relocating, they can work remotely. And so a lot of people are looking at this, and when you live in a more expensive part of the country, which is almost everywhere, and you look at Milwaukee, that is actually quite attractive. And from that point of view, we have quite a bit of catching up to do here on the pricing. And what that does is, of course, it drives competition. So I'm looking here at something that's called the sale to list ratio. About a month ago, I published a video about the top 3 hottest markets in the Milwaukee area currently. I'm explaining there in very great detail what the list to sale price ratio actually is. Watch that. You can also see which ones are the hottest markets, and then I have 3 markets that are surprisingly low in competition right now, that are offering some opportunity. So it might be interesting to take a look at that. But in a nutshell, what this means is, when you have a list to sale price ratio of 100%, that means that buyers are just paying as much as sellers are asking for. Historically, list to sale price ratio is usually around 95-96%. Most people negotiate a discount. And this is kind of what we have seen here on a national level. That's the red line here. We've been down to, 98% last winter. Winter is usually the low point here. And in the spring markets, it's going up. Here, nationally, we're over 100%. And Milwaukee here is almost at 104%. So that means on average, people paying about 4% more than what the list price is. We're seeing a lot of offers that are written 10% over asking price in the hot market. So this really speaks for the dynamic that is going on in Milwaukee. We are priced lower than the national average, but we are also very frantically trying to catch up. This is why you see these aggressive offers, substantially more than we have on a national level. All right, with that, what can we expect? What does the crystal ball tell us for the near future? I think the summer slowdown provides a little bit of a welcome relief for buyers. So if you have been in the market this year in spring and you gave up, we had a number of clients that fall into that category that are coming back into the market now because it's a little bit less aggressive than what we have seen in spring. So that helps, but we have to be realistic about it. It still means multiple offers on good listings and going way over asking price. So even though competition is coming down a little bit compared to where we were from, we're still a far cry away from a buyer's market. So still competitive. With that, prices will continue to rise. but most likely slower in the second half of the year. So this is why the second half of the year is always a better opportunity for buyers. It's still going to be pretty good for September, October if you're on the selling side, and then we're going into holiday season towards the end of the year. So with that, a slight increase of inventory might be possible, in my opinion, in the third quarter. Also, this is going to help on the buyer side. On the seller side, it doesn't really matter because we have such a massive overhang on there's so many more buyers than we have sellers. So it doesn't really impact that. And on the seller side, your ability to create multiple offers is not really impacted from that. The big wild card, of course, with that is mortgage rates, because that impacts, of course, buyers, but it also impacts sellers because they're rate locked, as we say. They've currently a mortgage that's maybe 2.75, 3%, a little bit over 3%. So it's very difficult for somebody to walk away from such a low interest rate and then buy a house, maybe even more expensive house with a higher rate. So if rates are coming down, we are expecting a lot of buyers coming back into the market that took a break, that said rates are just too high. And with lower rates and more buyers in the market, one thing is going to happen for sure, and that means higher prices. You can buy a house now as long as you feel confident with your monthly payment and you're not stressing yourself financially. You just refinance and take advantage of the lower rates without being exposed of the crazy competition that we will see when rates are coming down. So of course, everybody's situation is different. If you want to discuss this a little bit more with me, a lot of people are sending me an email after they've been watching one of my videos. You can also click on this link here. I'm going to put it in the description below here. That's a Calendly link. You have access to my personal schedule and you can book a Zoom call or a phone call with me. And we can discuss your personal situation, what your goals are, what your time frame is. If you want to do something in the next 6 to 12 months, I would say definitely worth to have a quick 15-minute conversation. So for me to understand your goals and your personal situation, and then I can give you some advice on what might be a good strategy that works for you and for your family. And with that, that's all I had for you today. Thank you very much for watching, and I'll see you soon.